Welcome to the NEREJ NYREJ podcast. I'm your host, Rick Kaplan. Today's podcast is sponsored by Cassidy Paving. Contact Cassidy Paving at CassidyPaving.com for all your paving needs. To be a sponsor on our podcast, contact me at rkaplan at NEREJ.com. And our guest today is Stef, and he is with Nexa Lending, and he is what we call creative lending he's going to discuss during the program. But before we get to that, Ben, tell us about your journey and how you got to where you are today.
Yeah, Rick. Well, hey, thank you for having me on. First off, I appreciate it. And my journey is I feel like to sum it up, I had to grow up fast. And I'll say that because I came from an immigrant family. And so I had to help my dad run his construction business and eventually his glass company at a very early age. So, most of the weekends, my friends spent, playing, hanging out. But most of my weekends typically were helping finish jobs that needed to be finished before inspection was due, right? And so I kind of grew up with all my aunts and uncles. My dad actually has 9 siblings, so all of them are business owners. So I'm in a very entrepreneurial like family. Ironically, all my cousins aren't business owners. I'm like the only one of my generation that's like a business owner. But anyway, so all of my aunts and uncles, I grew up in this sort of environment where you had to, you eat what you kill and you have to make it work and figure it out. And I think the immigrant mentality is work very hard, but not smart, in my opinion, because of course they didn't grow up in the American system. They don't know the American system. They don't know the game that they're playing. Now some do. I'm not saying that all of them don't, but like we're from Romania, and so Romania does real estate differently. So I grew up in kind of the real estate space with rehabs and fix and flips, and I would see guys, Rick, that would come in suits while I'm carrying up drywall, Durock, and 90-degree weather, and I'm like, what are these guys doing? They show up for 2 hours and they leave, but they have all the money. So I always wanted to be that guy. I was like, what's that guy that owns, like, who is that guy that owns the building? You know what I mean? Like, that was the person that I wanted to be. And so I just found lending to be my vehicle, right? Because I knew that I have to have active income somehow. I need active income to buy the assets and to produce things that would have more passive income, whether it be commercial real estate or small residential multifamily. And so lending is just the vehicle that I basically went into because I wanted to be somewhat in the real estate space. And then so I just help investors for a living get creative financing, HELOCs, right? Second liens on their investment properties, closing and LLCs. And then I help a lot of guys do that so I can have my income to be able to do the things that I want to do. So yeah, that's pretty much my story. Does that answer it, Rick? Is that
Oh yeah,
good?
that was a very good explanation. What really hit a point was you said you had 9 siblings.
So no, my dad had nine
Oh, your
siblings.
dad had nine
Siblings. My dad
siblings.
had
Oh, okay. Because I
nine
was going to
siblings.
say,
Yeah.
these 9 siblings in this day and age, you don't hear that there very often. But so you didn't come over
No,
from Romania, your
no.
parents did, correct?
Yeah. Parents. So I was born here.
Oh,
Yeah.
okay.
Correct. Hmm.
Yeah, it's completely different coming from an immigrant family with the work ethic. And you say you're the only one out of your
Yeah.
cousins and your generation that actually owns their own business. But I'm sure all of them are all hardworking people.
Yeah. No, they are. They are. Well, some. I'll say that. I'll say
Most
some.
of them,
Some are.
yeah, most
Some
of
are.
them,
Not all of them.
yeah. But
Because
the thing is
the
that
typical.
it's
Mhm.
it's all from what you see when you're growing up. You say your father was a hardworking man, and I'm sure your mother was probably a hardworking woman also.
Yeah.
That they worked from morning till late at night, to get the jobs done because they had to make an income, and so they understood that process. They weren't looking for the handout.
Yeah.
They were
Correct.
looking to make their own money. So, uh, you know, I know I come from a family that have were immigrants, so I understand that whole process as well. But you got into lending money.
Yeah.
So that's interesting. Going from the construction and a glass business to lending money. You know, how did you find that your way into the lending industry?
So at first, it was an accident where I just wanted a career and I was done working for family and working with my dad. I kind of wanted to be on my own and do my own thing. And I love working with my hands still to this day, but I wanted to not break my back and kill my body before I'm 30, you know? Um, so I was thinking I wanted to do something more in the office, and so I found a mortgage job where I just basically contacted refinance leads online. And so that's all I did in the beginning part of my career. And then slowly from there, I went, every job I took after that was at a smaller and smaller company because I wanted more and more freedom, because I wanted to do things my way, basically. I kept butting heads with, upper management, and because they had a way and structure of doing things, and I had all these other ideas because I think very outside the box. And so when I realized that, wait a minute, this can be a career. Like this is not some like IT job or software engineer job where you just work a job and you come home. I'm like, wait a minute, I can actually make a career out of this where I can. This is my own. Like all my clients work with me because of me, so I can. So I'm like, okay, why don't I just start my own thing, right? And so I went under Nexa. Nexa basically allows you to run sort of like a franchisee model. You can run your own McDonald's, so to speak, under the umbrella. And so eventually I landed here because I was like, well, I'm doing all the work, but I'm giving all my money away to all these people above me, right? So we have to have higher rates and charge more, and I'm getting paid less. And I'm like, well, I'm getting all the business, and they're not really doing anything for me. Similar to realtors, right? So I eventually just went on my own because I'm like, well, why not just keep most of the money that I make, and then that way I charge less, and then I always save more. So yeah, that's how basically my journey went from like I didn't care, Rick. In the beginning, I didn't care. I wasn't trying to start a massive business and grow, and I was just like, I just wanted a job, whatever, related to real estate, and then eventually it evolved from there. Yeah,
So you saw what they were making. You saw that that was a lucrative type of business. So,
yeah.
but you were
People need
sharing.
it. Yeah.
You were sharing. You didn't like sharing.
Yeah. Yeah, well, I didn't like sharing when it was like I'm doing all the work, I'm getting the clients, I'm helping the client start to finish. I'm there. I'm an active person. I'm not like hiding behind my phone or my computer, right? Like we're very hands-on. And yeah, and then they took their share and I was like, well, that's not fair.
Well, now that you're in their position, I'm sure you think it's fair.
Yeah. Yeah.
Yeah, so that's how it works, basically.
How it works.
Yeah. So when you came into your own, you developed something what you're calling creative financing. I mean, we've always
Mhm.
had that term creative financing, but you kind of putting a little different spin on that, and it's for more commercial.
So I mean, yes and no. Like we do have a lot of creative products that I've done for commercial. The main focus that we've been right now, because we've been developing these lines of credit programs that are backed by fintech companies and they use AI now. So we're basically closing them in a week and a half, and they're made like for investors. Where before you can never get a line of credit on an investment property up to 4 units, right? So I'm mainly speaking, Rick, to the 1 to 4 unit properties, as we don't have a commercial line of credit developed yet, but that might be in the works. And so that was like our main like creative one amongst many, but that was the main one. Yeah.
So you're talking about a refinance.
Yeah. So if you have equity, because a lot of COVID rates, people took advantage of refinancing into them back, 2020 to 2021, 2022. And so a lot of equity built up since then. And investors switched their properties into an LC. They became full-time investors. They quit their job, so they're self-employed. So a lot of them can't touch the equity. So we saw that as a problem where a lot of guys have this equity that they can't use. And they wanted lines of credit and it didn't really exist. So we basically developed that, for that reason. Yeah.
Now, with the lines of credit, does that mean that they can do finance repairs and refurbish properties,
Mhm.
or does that mean they can take that and buy additional properties, or they can do
So
either
both.
one? Yeah.
Yeah, both. So some of my investors, I'll just speak to the recent examples that my guys are using them for. One guy used it to add a bedroom and a bathroom to his rental property because he wanted to change the floor plan a little bit because his tenants were moving out. The other one wanted to pay off a lot of debt, and then the third one wanted to use that as a down payment DSCR loan for I believe it was a 6 unit property. I believe it was a 6 unit. And then another guy wanted to use it for a 3 unit. So, yeah, you could actually use this money, draw on it when you need, because you only pay interest on what's active, right? Like a credit card. And you can draw on it and you can use it to buy more real estate and start the Burr method again if you want. So that's why it's really effective. Yeah.
Now, with this creative type financing, is there any kind of limitations on how long they can take that money out for? Can they borrow it for 3 years or 6 months?
Oh, yeah. So typically the terms are 30 years, 20 to 30. Most people can pick, you could do it shorter if you want, but the draw period, Rick, is usually 4 or 5 years, depending on which product that they pick, depending if the property's in an LLC or not. So typically it's a 4 year draw period. So at any time in those 4 years, you can draw and pay off as you want, as many times as you want. No problem. And then after the 4 years, it just turns into a regular loan if you have a balance at the end of the 4 years. Some people do, some people don't, right? If you do have a balance, then you just make the payments as
and
normal,
this is
just like a
on their
normal
credit
mortgage.
on the credit line.
On the credit line. Yeah,
So
correct.
now, if
Correct.
someone comes to you, all right, this is something you talk about creative, because I've heard of
Mhm.
this happening, and no one has ever been able to tell me how it happens. Is you want to buy a three-family home and not put any money down? Is that something that's even possible?
I've actually made a lot of videos about this. There's no such thing as no money down technically. However, the closest thing to no money down, unless you're doing like seller financing, right? And they cover the whole down payment, which no seller would do, but maybe there's one in a million that do that. The closest thing to no money down technically is you leveraging equity to pay for down payment and closing costs. That way, you're not actually technically spending your own money. You're leveraging the equity to do the work for the down payment. In that sense, there's no money down. In the second sense, I have a product where if you've done over 30 flips in your lifetime, 20 to 30 flips or developments, we can finance 100% of a rehab and purchase loan. So if you find a property that you want to flip or renovate and hold, we'll actually cover 100% financing, 100% rehab, 100% of the purchase price. So those are the only two exceptions, I would say. Outside of that, like unless you're really lucky, there's really no such thing unless you're also raising money. That's the third case too, Rick. If you're raising capital from investors to where people will give you money to invest in a deal, but nobody's going to do that to some 20-year-old schmuck who's never held a job before,
Right, you
right?
need a
Because I
track
see this a
record.
lot online. Yeah, you need a track record, you need reputation, you need the know-how, and I'm telling you, I see this online from guys on TikTok and Instagram and Facebook. They're like, "Oh, 22, how I bought this 15-unit building, no money down." And I'm like, "Okay, what's the real story here, right? Like you didn't actually do no money down. You probably hustled and raised money from 100 people. I mean, props to you. Maybe that's how he did it, but like it's important to say that because
Right,
most people just think, "Oh, I can just go buy, with no money down this 20-unit building." It's like, yeah, it's
right.
not that easy,
And
buddy,
I
you
think
know?
it's important for people to understand that, especially people that aren't in the real estate industry, that
Mm.
there's no such thing as that no money down deal.
Exactly.
Because there's people that are saying, "Oh, well, that's great. I'm going to do that," and it ends up causing them a lot of heartache and a lot of problems
Yeah.
because
Yeah.
you can't get into a no money down deal.
Right. And that's the problem, Rick, with now video has compressed. I'm sure as you see, there's a lot of shorts now, right? Reels, TikTok videos. You can't explain everything in a 60-second video. So that's always the problem. You only get a compressed bite-size like view of whatever the person on the video is talking about. So a lot of the times you see these videos where it's like, yeah, I did this no money down, or yeah, I'm a millionaire before 25, right? Who knows if that's even true, first of all. But second of all, there's so many nuances when it comes to real estate. There's so many variables. Like I could be talking about the Chicagoland market versus the Fort Myers market versus LA and New York, right? And they all behave differently. I mean, even in Chicago, block by block, they behave differently, let alone comparing that to a different city. And so it's hard to always preface that in a video. And yeah, I agree with you. I think it's important to tell people because they think it's a lot easier
Well,
than it is.
now a lot of um, a lot of states are putting together some of these programs now for first-time buyers. And I
Mhm.
think it's first-time buyers for a residential home as well as some commercial properties. Have you heard things like that?
So I'll speak to the local programs. There are national ones that we've used that we've done, but every single program is built for typically home buyers that are buying a house, not buying a three family or four family. I do have a two unit down payment program. We don't use it often though, because there's some caveats to it. But it's rare to find a down payment assistance program that will help you buy a multi-unit property. There are some in my market in Chicago, but that's only through a non-for-profit if you're buying the developer's new construction deals. It's very, very niche. But for the most part, it's built for John and Mary. They want to buy a house, raise a family. You know, they're not trying to buy a property to like make income from it and all that. You know, sometimes you have to live in it for 3 years or 5 years. Sometimes there's a second lien that's forgivable after 7 years. You know, it's like sometimes there's a catch to it. But yeah, there are states and programs coming out with this money to revitalize and give homeowners an opportunity to buy. But the problem is the default rates are so high, Rick, you know, on these programs. Because
Right.
if people can barely scrounge up money to buy their houses, right? Which sometimes is the case, they're barely making it to the closing table. They have the highest default rates. Highest default rates. That's why grants are more expensive sometimes, or there's a catch to them because the lender knows I'm going to lose money on this because odds are you have bad credit and you don't have a lot of money and you're going to default on the loan statistically, which is kind of fascinating. Not all, of course,
Right.
but I'm just saying they're prone to it. They're more likely, and so they
But
know that. That's
but there's
you know,
when it's sounds too good to be true, usually there is a catch.
yeah.
You know,
Like Chicago came out with this aggressive grant, really good grant program. It just came out. The mayor announced it about a week ago, I believe, at the time of this recording. And it's great. I think they're raising 20 million. Number one, it's probably gonna. But I'm like, who's paying for this though? Somebody's paying for this somehow, right? Number two, the money's gonna go dry fast, so it's not gonna be available for long. But number three, inventory is tight, Rick. It's hard to find properties now where it fits what you're looking for, or you know, because people don't want to sell, right? Because they don't want to lose the rates that they got during COVID. But sorry, I cut you off. Go ahead.
no, I'm just saying, and you're right. You're absolutely right. But the uh, the market is tight, and some of the properties are also selling above asking price, which
Yeah,
makes it, that's additional funds that you have to come up with that the bank isn't going to cover because in
yeah,
your closing, you're going to need to cover uh, that money that you are paying over the market value, you know, correct?
yeah,
Yeah. So I
yeah.
mean, so that's
And
a
it's funny because people say, yeah, and that's correct. People say they want to wait for. Oh, go ahead.
no, no, go ahead. Well, people say,
Oh, sorry, I think
yeah,
connection there. I was just gonna say people, wanna rate for rates to drop, and, it makes me laugh because I understand where they're coming from, where they're like, I'll buy real estate or I'll invest when rates go down to 4 and 5," and my argument is that, well, if you wait for rates to go down, what's gonna happen to demand? Is demand gonna go up or is it gonna go down? Demand's gonna go up. And if demand goes up, what happens to prices naturally? We see this in airfare. We see this in Disneyland. Like we see this in home prices, right? Home prices and value and assets are going to go up because now there's more demand in the market, especially during COVID when you give people a lot of money, asset prices are also going to rise too. But the point I'm making is that a lot of people during COVID are now catching up to the values that they bought the properties for because they paid 50,000 over asking, right? For commercial real estate, it's different. We look at values, yes, we look at comps, but we're looking at cap rates and NOIs. We want to see, okay, what's the rental income? So it's a little bit different, but I think during COVID, particularly, a lot of people overspent on the properties that they bought because rates were so low. So everybody was buying and everybody was selling, right? It was so easy back then. Back then, meaning 4 years
Right.
ago. Um, and so that's why I actually don't want rates to go down as a lender, which is crazy to say this, but that's my opinion. I'm in the opinion of I actually want rates to be at the 6 to 7% range, Rick, because historically, okay, this is something too. I'm going on a tangent now. I'm sorry if I'm talking too much, tell me. But um, we say rates are high. I actually think mortgage rates are not high. We say that because cost of eggs used to be one price and now they're another price. Cost of 2x4s, of lumber at Home Depot, Lowe's, Menards, they used to be what? A couple dollars. I forgot now. I haven't bought a 2x4 and I can't remember how long. Last time I bought it was 10 years ago. But so the prices 4x'd, 5x'd for lumber, right? And so rates also went up the same time everything else went up. But historically, mortgage rates have been way higher. They've been upper sevens. The average 50-year mortgage rate was like 7.6, 7.8, right? And so we're complaining, oh, mortgage rates are so high. Well, yeah, compared to 2%, then everything's high, right? Then they will always be high if you compare it to an anomaly that happened that will never happen again. So I think it's also important to distinguish that, like, look, I don't think rates are going to come back down. And I think the smart investors right now are making it happen regardless of what's going on. Like they're finding ways to get the deal, to win at the purchase, and to find the value add strategies or the properties that need work to raise the rents and to do the rehabs that they need to do. And I think that's how you win in this market. That's my opinion, my 2 cents.
Yeah, and I think you're right. I think a lot of people that, well, I shouldn't say a lot of people that have bought homes in this crazy peak market that we've had, where they were overpaying. Some people I've heard of people paying over 100,000 over
Yeah,
asking. And now, after maybe 3 years of living in that property, and they decide, what, it's time we move out, we buy something else. They can't. They're going
yeah,
to lose money, and
yep,
that's what the big problem is. That they've overpaid for the property before they overbid on the property.
yep,
The prices were too high. So I
yep.
mean, now you're going to find a lot of people that they're selling. They're going to sell for at a loss probably. And
Probably at a loss. Yeah,
yeah, I mean, unless they want to hold on to that house for 30 years, I don't know if they'll ever make that money back. So, the kind of theory on residential properties has changed a little. That scenario of buy a home for $10,000, hold it for 3, 4 years, and sell it for 50,000. That's not happening. I'm sure it does still happen on occasion, but it's not
yeah,
happening all the time. You have to hold on to your homes now for at least 10 to 15 years before you start seeing any kind of equity growth in
yeah.
that.
100%. I mean, pre-COVID, probably not, because if you bought in 2018, 2019, you kind of got lucky because a lot of prices went up and then they never really like we've had some corrections and some softenings, but we haven't had any like crashes where your home went up to 500,000 when you bought it for 3 in 2019 and then it goes back down to 300 or 400. Like we're not really seeing that. We're seeing them level off or soften, right, as I mentioned. But yeah, I think in long term, like if you're looking at it from long term lens, yeah, you're not going to see equity shoot up. And but in my opinion, if you're buying a house to live in it, that's not the goal. Like, I'm buying a house because I want to raise my son or my daughter. I want my wife to have her studio. I want an office. Like, I'm not buying a house because I'm looking at I have this I have some it's so funny. Like, I have some clients that I work with. They look at buying a house like they're making an investment. And it's like, yes, you could say it's an investment, but they look at it as like they're making a return on a stock market. And they're looking at what's my ROI on this? What's my
Right.
equity gain? What's my appreciation percentage and likelihood that it's going to? And I'm like, I'm like, you're not buying if you're buying a 10 unit, let's have that conversation all day long. But if you're buying a house, like, who cares? That's just my
But
opinion.
see,
Like,
and
if my home value goes down, let's say 20%, I don't care. I'm not selling.
right,
I honestly don't care because as long hey, I have a house, it works, it's not breaking down, that's what I care about. Now for my investment
right,
properties, different
and
story.
that's exactly
I'm
what I
kind of
was saying.
exaggerating, but you get the
Yeah,
point, you know?
that's what I was saying because people and that bought homes like in the 70s and the 80s, they held on to their homes for 20, 30 years and then sold it. And yeah, it's kind of their nest egg. Uh, People that are buying homes now, 20, 30 years, you might see that little nest egg, or there could be a correction, and that house could be worth by the time you're ready to sell exactly what you had paid for it, or,
Correct.
or less. You don't know.
Correct.
We're at that peak where it can go either way. So, it's
Yeah.
unfortunate that people, and I understand people are looking at it as an investment because there were people that were buying homes in the prime when they were like, you could buy a home for 250,000 and sell it for $400,000
Yeah.
2 years later. But those days are gone. But
And you
people
don't
remember
want
them.
that. Yeah, and you don't want that to happen because if prices keep going like right now we're at the largest gap between median salary and median like household income and home prices. So if we keep broadening that gap, it's just going to make it harder and harder for the average Joe to buy a house. And that's not what you want. You don't want to squeeze out the middle class. And I think to some level that's what we're noticing is unless you're really successful and you're financially in that higher bracket, buying a house is going to be pretty much of a struggle because we've kind of inflated these asset prices so much.
Right.
And to whose fault? There's many factors at play. When we dumped all this money into the market during COVID, we gave everybody money. What does that do when you give rich people too and wealthy people the opportunity to have more money to spend more money? It's going to drive up asset prices because they're going to buy more assets. So that's I think what we saw happen. And I'm not making a case against, for communism or anything. Like, I don't want, I'm not saying that, right? Because
Well,
of
that's
my
a good
parents, we fled
thing.
communism.
Yeah.
I'm not saying, okay, like, let's, tax the rich and make everything level, equal. It's like, I'm not saying that either. But I'm just stating what I've noticed happened. And so, yeah, in some markets, I think it's harder. You have to have dual income. You need the husband, the wife to work, right? Like you made the joke earlier. We're not having 10 kids anymore. Why? Remember we used to have,
Oh,
everyone had 10 kids, 8 kids,
yeah.
15 kids, right? So, anyway,
Yeah.
yeah.
Yeah. I mean, who can afford that? It's
Yeah, yeah.
everything is expensive nowadays, but it's life. You know, 20 years from now, everything will be probably in great shape. We'll, as long as we don't become communists,
Yeah, yeah, right.
But
Yeah,
so
and
what
yeah.
markets can you lend to all different markets throughout the country?
Yeah, so for commercial investment loans, predominantly, I'm nationwide, Rick, so in any market. With New York, we have some issues with them. They're very hard to work with on a state level, so we're trying to get some products approved with them. I can do some loans in New York, but I don't think all. I have to see because they've been changing it this year, but yeah, virtually nationwide, Rick. Mhm.
Now, Ben, do you have a website that people can go to
Yeah.
so they can see?
So
What's
there's
that?
two main platforms, Rick. Fundingfreedom.net. It's my website, or Funding Freedom, and then my name, Ben Steph, on YouTube. If you go to YouTube, that's my predominant platform where I showcase and teach investors about these programs and how to leverage them so they could buy more assets and scale. And so you could go on YouTube and find me there as well. You'll see the content.
Well,
Yeah.
Ben, it's been very interesting. I'm sure things change so frequently that you're probably keeping very busy.
Yeah. Very busy.
Well, I do
Yeah.
appreciate you coming on and
Thank
telling
you,
us a
Rick.
little bit. We're talking with Ben Steff, and he's with Nexa Lending. And Ben, do you want to give us that your website again?
Yeah. Website, if you guys want to find me, is fundingfreedom.net.
Great. Well, I want to thank everyone for listening to the NEREJ NYREJ podcast. I'm your host, Rick Kaplan. Today's podcast is sponsored by Cassidy Paving. Contact Cassidy Paving at CassidyPaving.com for all your paving needs. To be a sponsor on our podcast, contact me at rkaplan@nerej.com. Until next time.